Hello viewers and welcome to another episode of the Solve to Evolve podcast. It's been quite some time since we've been together, Jono and Bloxy, but we've got the band back together. Welcome. How are you guys?
Good to be back. Thanks, Phil.
Yeah, the dream team has reunited. Well, look, on today's episode, we're going to cover a few topics. The first one is the main residence. The second topic is, are you carrying on a business? And the third one is, what should business owners be considering or be doing during high inflationary economic times? But to start off, we wanted to touch on the main residence. Now, when we think about investments, we usually think about shares or buying investment property. But Bloxy, can you tell us what is the most tax efficient investment in Australia?
Thanks, Phil, for that leading question. And the answer, of course, is the main residence is the most tax efficient asset that a continuing Australian tax resident can buy. There's a number of reasons why, but typically whenever a new client, typically a younger client hits my desk who does not have a main residence, I will advise them that a main residence is a smart thing to do because I'm a tax head and I understand the benefits of buying a home that you live in this country.
Yep.
There's a number of reasons why. So probably the one that everyone knows is that it's exempt from capital gains tax. A few more things that people may not be as aware of is that it's also exempt from land tax in every state and territory. It's also exempt from the pension assets test. So there's a lot of wealthy old widows living in Vaucluse, collecting the pension, getting discounted council rates from a very expensive main residence. Exempt.
Yep.
Another one that is sometimes overlooked is the ability to use an offset account. So if over your lifetime, let's say you're lucky, you buy your first home when you're 20 and you have an offset account for your whole working life, instead of deriving assessable interest income on your spare cash that you might have sitting in a term deposit or a savings account, you're saving on paying out non-deductible interest on your mortgage at the mortgage or rate. So just that single kind of scheme or plan that you can work over time is a massive advantage. And over a whole working life, you assume it's going to be kind of 40, 50 years, it would have saved you.
Thousands, right?
It could be, absolutely hundreds of thousands of dollars that you don't have to work for. It's free money.
Yep.
More so as the interest rate increases.
Absolutely.
As we are currently.
It's a very good point because interest is accrued on a daily basis, right? So, the more money that you can put into the offset account, the better for yourself long term.
Absolutely. So for what I say to clients is for every spare dollar that you have, try to leave it in an account that offsets non-deductible debt. So the most productive non-deductible debt that you can have is on your main residence. Try to leave that dollar in that account for every day possible.
Yeah.
Particularly, as you guys have correctly noted, as interest rates rise.
So how do you make it deductible? Is probably the next question.
You can make interest on a main residence deductible by moving out of it and using that former main residence to produce assessable income. So the deductibility of interest on any asset depends on its nexus to the production of assessable income.
Yep. Are there any other reasons why the main residence is the most tax efficient?
There are.
Asset?
So it's also efficient on inheritance. So as long as the beneficiaries of an estate who inherit a main residence sell that property within 2 years of the date of the testator's death, in all circumstances, that will be exempt from CGT. And the probably last one that I would say, there's more, but another big one that is often overlooked is the ability to extract equity from your main residence without paying tax on it. This is done in Australia through what are called mortgage variation payments. So if the value of the property goes up, the bank is willing to lend you more money on that increment in value, and that allows you to get access to cash without having to pay capital gains tax on what would usually be what we refer to in tax land as a CGT trigger event, because you've cashed in or your hands on actual liquidity from an asset. So a main residence, for a whole host of reasons, that last one, the excess cash, would typically be used to buy another investment property or to invest in a business or do whatever you choose to do with it. So it's very rare in Australia that you can do that tax-free.
And Bloxy, for tax purposes, when does the house or the home actually become your main residence?
That's a great question, Jono. And for those of you who are watching out there, might be business owners or just workers working away to pay your property off and are thinking about that question, there is no strict legal test as to when a property becomes your main residence. It's often confused with the 6-month rule. The 6-month rule is there for state tax purposes. So typically, if you get a first homeowner grant or a concession for stamp duty in whatever state or territory you're in, you're required to live in the property for a certain period. The state guys call what the federal guys call the main residence the principal place of residence, the PPOR. That test is different to the income tax rules, which are federal. And essentially, a property can become your main residence after, in theory, a split second.
Once you sign the documents.
That's right. So if you sign the documents, you get the keys, and you intend for that property to be your main residence, for income tax purposes, it can be. Right. However, it's what's called a question of fact. So the weight of indicative facts will lean towards one conclusion or another if it's in front of a judge, which it rarely is. There are some cases on it, but what that means is that the more evidence you have that the property is your main residence, the more likely it will be that it will be your main residence. So evidence is things like utility bills. It's very unlikely that you're going to connect gas and water, power in your own name to a property if you don't intend to live there. Now, if you've paid one quarterly bill, that's pretty good evidence. If you've paid 2, that's even better. But by the time you've paid 3 quarterly bills, it becomes almost irrefutable that that property is your main residence.
But the onus is on the taxpayer to prove that in that circumstance, right? If the ATO would to ever say, all right, you've sold your main residence, you've claimed the main residence exemption, prove it. Is that right, or is that?
That's right. So that's true in all cases for tax law. You have to prove your case with documents. So what some people may not know, Phil, is that when you sell your main residence, it is actually a disclosable CGT event on the tax return, but nobody ticks a box. It is exempt, but very few people, even very few people in tax land, would tick that box because everybody is so colloquially understood that the house that you live in is exempt from income tax that nobody gives any thought to the fact that it is still a CGT event.
Yeah.
So you're right. You have to prove that it was your main residence with documents if you're ever asked to do that, but it's very rare.
So how will the ATO ever know? I mean, have either of you seen cases where a taxpayer client has been audited for main residence exemption on CGT?
Not on CGT. Right. The ones that I've seen are where the state guys have disputed the first home concessions. So in some cases, because that's an actual cash handout at the start, well, it's a duty saving at the start. So it's more likely that you will have a state audit on that, in my experience, than a federal income tax audit on a capital gain.
And on that point, I think in New South Wales, at least, they put the time frame that you have to live in the property up to 12 months. So that's coming in. I'm not sure if it's in already or from 1 July. It was 6 months, but
it's now 12.
Yeah, going up to 12 months. But obviously, that's from a state tax point of view, and it'll be different in other states around Australia.
That's a very good point, Joe. I just wanted to ask another question to you both about this. So I get this question a lot, or I hear it a lot. I'm sure you guys do as well. You have a client or a friend that says, just bought a house. I've moved into it for 6 months. Now I can rent it out. And then within the 6-year period, sell it tax-free. Is that a myth? Or is it true? What's the answer?
So I might be the better one to answer.
Yeah, go for it.
So the income tax law around the main residence, I just scattered throughout the tax acts, but really the core of it and what we'll focus on today is in 118B. So 118B of the 1997 Act is the main residence exemption. And what it says is that there's a basic case and then there's more tricky cases. So the basic case in 118 is you buy a home, you live in it for 10 years, then you sell it, full exemption.
Yep. Easy.
No questions asked, easy. That's what's called a basic case. The one that you've touched on is a more factually complex case, and it's called the absence rule. So there's 3 specific rules that I'll touch on to discuss today for the viewers at home. The first one is the absence rule. The second one is the partial CGT exemption for if you use the property to produce assessable income at some point in time throughout your ownership period. And the third one is the special rule for the first use to produce assessable income. So it's really important to know that not only on the absence rule, but on the other 2, that they interact. And in order to advise a client properly, or in order to properly exploit your main residence, if you've moved in and out of it over time, you have to understand or speak to a tax accountant who understands how these specific exemptions interact, because it can massively benefit you in at the end of the day, if you do make any type of assessable capital gain out of the property. So I guess we'll deal with the absence exemption, which is the one you brought up, Phil. So the absence exemption is in 118145. And essentially that absence exemption is designed for really military personnel. So personnel that are posted overseas for an extended period of time. So there's an example. The example isn't a part of the binding law, but it is important to read it because it gives context to the provision. So the example in 118145 talks about a person who's posted overseas, comes back, they're posted overseas again for another period, comes back, neither period exceeds 6 years. You sell the property at the end of their holding period, and it's exempt from capital gains tax under the 118145 absence exemption. What is really important to understand is that, if your mate comes up to you and asks you that, I think that's whatever we show up and do.
At a barbecue.
Yeah.
Probably the most important thing to understand is that you cannot use any other property as your main residence for CGT purposes during your period of absence. So that's why I come back to the military service personnel example, which is in the law as well. Okay, if you have joined the military and you buy a property and then you get posted overseas for 2 years, you're not living in the country. So you haven't moved into another property that you own. You haven't hung around in the country at all. So unless you move out of what was formerly your main residence and into a property that you're renting from someone else, or back home with mum and dad, or overseas, you're not even here, you cannot have another property that you are treating as your main residence for capital gains tax purposes. Otherwise, as soon as you acquire that property, it stops the 6-year clock ticking. But it is semi-correct to say that you can buy a property and once it has become your main residence, you can move out of it, and you have a 6-year window where you can continue to treat that property as your main residence, even if you are renting it out, using it to produce assessable income. And if you're not using it for that purpose, you can continue to treat that property as your main residence indefinitely.
Right. So if there was a situation where someone did move into a main residence for 6 months and then move out and used it to produce income, I think it does get a little tricky, but you'd want to make sure that you speak to your accountant to make sure that the 6-year rule would still apply, meaning that you'd still have the full main residence exemption.
Absolutely. In all cases, you should talk to a tax accountant.
Yeah.
And Phil, the other one, Phil mate, is making sure that going back to blocks.
It's not my mate.
Whoever
It's my mates.
making sure, go back to Bloxy's first point, that they actually make that property their main residence. So if they buy it and they never actually make it their residence, or in a way that they can provide evidence, then it's going to be an investment property from day one.
Yeah.
In which case you won't get any of these exemptions. So that's an important one.
Yeah, and obviously making sure that you've got all that document in a safe place for X amount of years, just in case.
Yeah.
Okay.
So there was another exemption that we were going to touch on briefly.
Yeah. What is the partial exemption?
So the partial main residence exemption is in 118185, and that it's based on a concept of apportionment. So the calculation is that your capital gain or loss times your non-main residence days on the days in your total ownership period. Worked on one of these yesterday as well, advising clients. So what you have to do is you have to put the date in the date format into an Excel spreadsheet, and then you have to minus A from B. It gives you the total ownership period.
Job, mate.
So then,
but
then it's an apportionment. So if you've used the property for half of your ownership period to produce assessable income and half of the time it was your main residence, then you will get what's called a partial exemption under 118185.
Yeah. Got it.
Now that one as well, you have to understand how that works. There's a special rule. So the special rule is in 118192. And that's the special rule for the first use to produce assessable income. So if you buy a property and it becomes your main residence, and after 2 or 3 years, say you move out of the property and rent it out, it's a very common scenario because typically first home buyers buy a property that is lower priced, higher yield. It might be a home unit somewhere and they might want to upgrade because there
might be a rent investor.
Might be a rent investor, might have had a kid, whatever it is.
Yep.
So they need to step out into something bigger. In that case, on the day that you first rent the property out or that you intend to rent it out from, okay, so on the day that it becomes available for rent, that day is known as the income time. Okay, so at the income time, whatever the market value of the property is at that time, that number is substituted for the cost base that you would otherwise calculate under the tax law. So it kind of works as it wipes the slate clean and says, well, whatever costs you have incurred to date that may have been the first or second or third or fourth element of the cost base, ignore all that, get us a market valuation as at your income time, and then that is your cost base for CGT purposes for when you ultimately do sell the property.
That's probably more beneficial then, wouldn't it be, for the tax
Typically, you would get an uplift.
Yep.
Typically you would get an uplift. The way that I would advise a client to do that is they can pay for a formal valuation, or you can simply ask the real estate agent who is going to rent it out for you, can you print me out a list of comparable sales as at this point in time?
Yep.
You know, it might be a 2-bedroom, 2-bathroom unit in Miranda.
Yep.
And you want a list of comparable sales, and then you pick a midpoint. You say, this is the one that we're going to use for my cost base for CGT purposes as at this point in time, and just give it to your tax accountant, or just scan it in and make sure you've got a copy of it on file so that you can refer to that in the future if and when you do ultimately sell property.
Thanks, Bloxy. That was a lot to take in for the main residence, but who knew there'd be so much to think about when it comes to your main residence? And it's not really that easy as just, hey, let's live in it for 6 months and then, sell it and it's tax-free. There is a bit more to it. Thanks, Bloxy. So moving on to our next point. For our viewers out there, if you are thinking about a side hustle, you're currently running a business, or you think you're running a business, from a tax perspective, there's a question that needs to be asked, and that is, when are you actually carrying on a business for tax purposes? Jono, can you tell us what the viewers should know about their situation to understand if they're carrying on a business or not?
Yeah, so it's really a foundational question from the tax law, and it's something that has a particular definition which is backed up by a lot of history and case law, and it typically comes up for people who are engaged in side hustle type businesses, or someone who might be investing but trying to turn that into more of a business activity. So you could do that with crypto, you could do that with shares, or even property in some cases. So it typically comes up for those sort of scenarios. And reason it's important from a tax point of view is it's usually better to be carrying on a business because you have an access to more tax deductions in that case, as opposed to if you're an employee, every deduction you claim has to have a link to actual income. Whereas if you're carrying on a business, everything related to the business is potentially tax deductible. There's also other concessions that I could go into, but just so the listeners know that carrying on a business, there's lots of benefit there to be had. I suppose it's the government's way of trying to support businesses and support jobs, if you're going to create jobs from running that business.
Right. So you mentioned something very interesting. So as an investor, it would be more beneficial for you to be treated as carrying on a business. Can you speak to the audience about that and how that works? Because I would have thought, me being an investor, I invest in shares or property, I sell it, I'd then be subject to capital gains tax. But you're saying running it as a business, it would be more beneficial. Is that right?
In some cases, yes. So it depending on your structure. So if you're set up as a company and you're carrying on an investment business in there, it would probably more likely be more like a business rather than just passively holding assets to earn passive income and capital gains. So the distinction is really, are you holding investments for long term and to build passive income and derive capital gains? That's not business, that's just investing. Or are you more actively being involved with your investments day to day, doing that as an activity, right, to earn profit?
Like day trading, for example.
For example, yeah, if you were talking about shares or crypto. Yeah. So there's other capital gain concessions that you can get from the assets that you use in a business as well. So there's the small business CGT concessions, which particularly around retirement and where you're holding assets for a while and using them in business, up to 15 years, there's very, very valuable tax concessions around those. So I'll get into basically the ATO ruling and when you are carrying on a business. And there's a number of factors. And again, it's a fact-based thing. You got to look at all these facts and think about, in reality, how does it apply to you? So firstly, you have to look at your intention. Are you trying to be an active business or are you just trying to build passive income? If you're just trying to build passive income, it's not a business. So
how do you prove your intention?
I think what you can provide evidence and show that. So I think if you have a business plan, I think if you have, if you've consulted a business advisor or something like that to show that this was my intention at the time.
Yep. Okay.
Comes back to that. The second point is you have to have a profit-making purpose, and there has to be a prospect of profit.
Well, that's why you get in business. You don't get into business to make a loss. But yes.
Exactly. Yeah, that's right.
But does it matter whether or not, Jono, you actually make a profit?
So whether you actually make a profit, there just needs to be a prospect of profit. So if you're, in the early years of business, you might be making a loss and you're funding those from your capital or debt. But you have a plan to, after, a certain number of years, for that to turn into a profit. So there just needs to be some prospect. I think if you're doing an activity that, it talk later on about a hobby, but, a hobby is something that will never probably make a profit because doesn't really have that intention. The third point is that you're doing repeated and regular activities. So in the tax law, they talk about, you can have a commercial profit-making intention from a one-off transaction, but you can't have a business from that. So a business is something that's continual, it's regular, repeated. And lastly, I'll just touch on the size and scale of the business. So if you're committing a significant amount of money, time and resources, the more you commit to it, the more it looks like a business.
Yep.
So if you're taking loans or you're using your own money, you're investing that into the business, and that's a significant amount, then that tends to say that it's more like a business. Whereas if you're just, using your pocket money to engage in a hobby, basically.
Yeah, so basically what I get from that is it's if you are running a side hustle or you've got a hobby, you got to think about, if you are thinking about turning it commercially, ideally you want to make it into a business because there are more tax concessions available to you as a business owner rather than just as, doing it as a hobby or a little side hustle.
Yeah, that's right. So, I mean, with a hobby, that might be something that doesn't even get taken into account because you're probably making a loss out of it anyway. And those losses, if you're an individual, probably wouldn't be able to offset against your other salary,
Right.
main income. So, so it kind of gets treated separately.
Yeah.
But I'll give an example. So, say if you're a crypto or a share trader.
Yeah.
If you have a trading system, if you have a business plan, if you've invested significant capital into that, let's say 50,000 or more, you're trading regularly, like every day, repetitively, and you don't have another source of income, then that's pretty much likely to be a business.
Yeah.
Contrast that to someone who might be crypto trading on a Saturday night after a few drinks, getting onto Binance and trading some meme coins. That's unlikely to be a business.
Yeah.
So that's when any of those sorts of assets would be under your usual capital gains rules and not a business.
Yeah. That's more like a hobby then, really, doing it for fun.
Except where you're trading capital gains assets and you'll still need to think about CGT.
Yeah.
So
of course.
On that example.
Yeah. Excellent. Thank you, Jono, for your talking points there.
Any other questions?
Just talk about Division 35 for a bit.
Yeah, so in that case, if you're on a high salary, PAYG, and you have a side hustle, little small business on the side, if you're carrying it on as an individual, then you can only claim those losses if you're making a loss from the side hustle. You can only claim it where you're earning more than 20,000 or you've got a certain amount of assets. I think it's 50,000.
Yeah.
50,000 of assets.
There's a few tests.
Yeah, there's a few tests that you'd have to jump through to be able to offset that against your other income.
That's only if you're doing it as a sole trader, right?
As a sole trader, yeah.
Right. So if you're not doing it as a sole trader, so if those Division 35 rules don't apply, so let's say that you have a side hustle that you're running through a company, for example, what happens?
So what would happen then is if you have a company, there are different rulings from the ATO out of when is a company carrying on business versus when is an individual or trust or something else carrying on a business. And most of the time a company will be carrying on a business just because of the structure itself. It's set up with shareholders who expect to receive dividends from profits. The only exception is, if you just set up a company to hold some personal use assets or carry on a charity or something like that. But for a side hustle, if you had losses in that company, they're going to be trapped within that company. So you won't be able to offset them against your salary income. They'd be carried forward in the company until such time as you have profits within that vehicle.
Makes sense. Excellent. Thank you, Jono. So we'll just move on to my point now.
Yeah, Phil. So we're currently living in high inflationary economic conditions.
Yeah.
And that's putting some pressure on people, particularly business owners. So what are some financial strategies that you advise business owners to implement to help them survive and ride out the tough times?
Yeah, thanks, Jono. So, right now it is, it's a bit tough for a lot of clients that I've been speaking to, but I think broadly Australia or business owners in Australia are feeling the pinch from what's happened from the RBA or the decisions made by the RBA over the last year and a half. So we're starting to feel it now. But, the first thing that comes to mind is pretty obvious. It's review your costs. I mean, that's pretty straightforward. Look at what you can reduce, what you don't need, do a detailed review. And this is very important now more than ever to actually understand your numbers. I see and work with so many small business clients that have no idea what's going on. They have a feeling about their business. It might be going shit, it might be going great, but they don't actually have the numbers to back it up. And as you guys know, numbers don't lie. Men do, women do, but numbers don't, right? So review your costs. That's the first thing. The second thing, this is something that we also haven't done at times, and that's look at increasing prices on our services or products. Of course, you want to make sure that it's comparative or comparable to the market so that you're not outpricing and then, not outpricing, but you're not losing your client. Making sure that you're communicating that to your client base as well, that of the increase and why you're increasing it. Those two things alone will help the business owners cash flow and profits and help them ride the tough times. The increase in sale price and the reduction in cost, that's going to do good things for the business performance and profit. But what about the cash? Business owners should be thinking about how you can collect cash quicker and how you can, prolong the outgoings of cash, because, cash is the oxygen to your business. So in terms of receiving cash quicker, you might want to offer discounts to clients, 5-10% you pay up in full now, or, pay up front, then provide the service, whatever it may be, just try and get the cash in as soon as possible. Prolonging your payables, communicating that with your suppliers to say, hey, let's extend payment terms, whatever it may be, have that discussion to prolong. That's going to keep more cash in the business during tough times, and that's going to help you survive during these times.
So that's probably from the numbers perspective, like the cold, hard kind of financial stuff from the black letter accountant kind of perspective. But what can, like day to day in like an operational context, what can business owners do to get through these tough times?
It's a good question. So, operationally, we've all heard AI and technology, or heard of technology right now. It's evolving so quickly that in most industries, there are specific systems and applications that can be implemented within your business to help streamline and make it more efficient. And that will generally lead to a reduction in labor costs, for example. That's going to be huge things for the business, which you may not see immediately because there's a time lag from implementation to then actually feeling the impact of that. So thinking about and looking into systems specific for your business, but also if you're not already using ChatGPT for administrative or basic marketing, whatever it may, like the basic sort of back office work, then you need to get on it as soon as possible, because that's also going to save quite a lot of time, which then, if it frees up your time, it allows you to do more value add work on the business. The second thing is potentially looking at your value proposition, your services or your products. How can you provide a better service or more service and get more cash into the business? So for us and for myself,
kind of like a do you want fries with that kind of stuff?
Yeah, exactly right. So, the first thing you should be looking at is operationally, are my offerings good enough? Should I be changing it to match what the market wants right now? You want to continually make sure that the product or the service that you're offering is up to date and that you're still providing the same value or better value than you were before, so that your clients are more sticky or customers are still buying from you. But always working on your value proposition or your unique selling point is very key. The third thing would be diversifying your revenue stream. So you might already have your core revenue stream, but what else can you add? Is it fries? Is it Coke? A large Coke, whatever it may be. Let's add more services to your business. But also before even doing that, you do want to make sure that the services or products that you are selling are profitable. And this is where it might be a good time for you to assess, especially if you're selling a product, what's the gross profit on that particular product? Or what's the gross profit on that particular service that you're providing to the client? Are we spending too much time providing that service and not getting enough? Doing a gross profit analysis on your business allows you to then rethink about how you want to position the business moving forward. Right? Because if you realize that, and let's just say tax returns, like accountants, if we're doing simple tax returns and we're spending a whole day collecting information, sending out queries, chasing the client, our hourly rate is, whatever it is, but we're charging a tax return. You might be a client a tax return for a few $100s. The gross profit margin on that specifically is going to be next to nothing. So for us as accountants, that's probably not the service that we want to be targeting or making, that is not the type of work that we want to be doing. We want to be doing work or providing services with high gross profit margins. So that is a key tip for business owners to consider.
So when you look at your costs, would you look at your direct costs as well for the services that you're providing and work out which ones are unprofitable?
Yeah, correct. So ideally you want to segment your revenue streams and go, okay, these are all, once again, for us accountants, an example, you might have tax return preparations, self-managed super fund, package, annual compliance work, payroll work, whatever it may be. What are the direct costs associated with that? We might be, for us, it's generally time, right? So how much time are we spending towards those services and are they profitable? Because if I'm making a huge gross profit margin on payroll services, then why not just focus on payroll to make X amount of money versus, simple tax returns where I'm losing money, right? So I think breaking that down and figuring out what are profitable revenue streams will then allow you to either fixate and fixate on that particular profitable one or start to think about diversifying your revenue streams to more profitable ones.
Yeah, awesome. And should they consider anything else as well?
Yes, of course. The other thing that they should be considering is budgeting and forecasting. Like a lot of small business owners don't do that. You think about making X investment, you want to hire new staff, you want to buy new assets, you want to market your business, all of that. You need to actually map that out. What does that look like? What's the impact of those decisions or those investments over the next 3, 6, 12 months? Am I still going to be in a profitable position to make those? And if you're not, well, then that's probably time for you to then curb those investments and not make them at that point in time. Maybe you make it 18 months down the track, but it's very important for small business owners to forecast to ensure they can see into the future for what their business may look like.
Yeah, it's a great tip. Need to know where you're going and have a game plan.
Yeah, without a plan, there's no direction.
Yeah.
You're just like a little lost puppy. That's it for today. Thank you, viewers, for joining us on another episode of Solve to Evolve. If you like what you heard on today's episode, please connect with us at podcast@solveaccounting.com.au and tune in to the next episodes.